Welcome to Business Pitfalls and Profits, where we unravel the captivating world of unfamiliar but successful corporations and explore the highs and lows of celebrity endorsements and partnerships in the business realm. Subscribe now to the channel and hit that notification bell so that you'll never miss an episode. And engage with me in the comments. I want to hear your thoughts, your insights, and even suggestions for future episodes. Funding rounds are a series of steps that a startup takes to raise capital from the market. The goal of each round is for founders to trade equity in their business for the necessary funds to grow and expand. We have pre-seed, seed, and series funding, all are different stages of financing for startups with distinct purposes and characteristics. Here are the key differences between them. The pre-seed round is where many entrepreneurs and investors might refer to as the friends and family round. While companies may take on venture capital, especially if they have experience starting companies and relationships with investors already, most of the time this is the first bit of money you scrape together. Your business is probably just an idea at this point, but you're still in a position to convince someone that what you've built or are building, it has potential in a market. Seed funding, also called seed money or seed financing, is referred to as such because it is money raised by a business in its infancy or early stages. The funds are used to develop a minimum viable product or MVP and conduct market research. This is the first official equity funding stage for a startup. And because it comes from different sources, it can often be a relatively modest sum. And investors at this point may not gain any voting rights. The series funding are labeled as A, B, C, D, and so on, but they still have different purposes and reasons for each round. And so we're going to start with Series A funding. The term gets its name from the preferred stock sold to investors at this stage. In this round, it's important to have a plan for developing a business model that will generate long-term profit, so it can be funding given to hire new employees, to expand into new markets, or to increase the marketing spend. Typically, Series A rounds raise between $2 million and $15 million, but this number could vary due to many circumstances. In this stage, for Series A, investors are not just looking for great ideas. Rather, they are looking for companies with great ideas and a strong strategy for turning that idea into a successful money-making business. VC investors or venture capital investors will conduct thorough due diligence on startup companies before handing over any money. And in this stage, the financing documents are generally more extensive and contain many protective provisions that impose significant restrictions on company actions outside of normal day-to-day operations. Series B funding. Series B rounds are about taking businesses to the next level, past the developmental stage. This round is often used to scale operations, to expand into new markets, or develop new products. Companies that have gone through Series A funding rounds have already developed substantial user bases and have proven to investors that they are prepared for success on a larger scale, and they may have demonstrated growth potential. So Series B funding is used to grow the company so that it can meet the levels of demand that has developed due to the growth of the company. Series C funding. Businesses that raise Series C funding are already quite successful. These companies look for additional funding to help them expand into new markets or even acquire other companies. In Series C rounds, investors inject capital into successful businesses in an effort to receive more than double that amount back. So Series C funding focuses on scaling the company, growing as quickly and successful as possible, and many companies will operate or complete an IPO or initial public offering after their Series C funding round. And it is often the last round that a company raises, although some do go on to raise Series D and even Series E rounds or beyond. Here's a note worth mentioning. Your seed round and Series A through B round were mainly about scaling your business. The later stage rounds, Series C and beyond, are more about preparing for an exit or an acquisition in business. Now, Series D and beyond. Now, by this time, your company should be a dominant market leader, generating tens of millions, if not hundreds of millions of dollars in annual revenue. And you should be working toward an exit or an IPO or an acquisition. All right. So you're looking to expand into adjacent markets. You're investing in long-term projects requiring research and development time, or you're preparing for an IPO or an acquisition. When you start talking about the valuation of your company, it differs for each round. And so the valuation of a startup can differ between pre-seed, seed, and Series A funding in several ways. So valuations for pre-seed companies are difficult because there's really no way to accurately measure the value so early on. It's all perceived value based on the current market forces in companies that are comparable to yours. Businesses at the pre-seed funding stage will have a market valuation of anywhere between $500,000 to upwards of $2 to $3 million, and is usually pre-cash. Seed rounds don't necessarily require a finished, ready-for-market product, but having an MVP is a good idea when you're looking to add a value to your company in the seed round. The amount of funding during the seed round is much higher than a pre-seed round, ranging from $2 million and more. And a startup should have an established business model, a defined product market fit, and an established founding team. Series A funding requires a Series A valuation, where the startup will be scrutinized more than ever before. Analysts will examine the company's metrics, your size, your track record, the management, any risk involved, and most importantly, the potential for growth in the market. Generally, a startup has demonstrated product market fit and has some traction in the form of user growth or revenue growth. Series A typically raises between $10 million to $20 million, and the investor base is usually professional VC firms, although a few strategic angel investors may be involved. Here are the metrics you should make sure your company meets before you go for pre-seed round. So remember, pre-seed funding is the earliest stage of financing for a startup, typically occurring in the ideation or concept stage before the startup has developed a MVP or generated any revenue for the business. Some key metrics that startups should focus on before a pre-seed funding round include the vision in your early team. So startups at this stage are likely to highlight their vision in the early team rather than their revenue figures that they have not made yet. The market opportunity. Startups should identify a clear market opportunity and demonstrate their understanding of that target market. The prototype or proof of concept. While not always necessary, having a prototype or proof of concept can help to validate the startup's business model and attract investors. User attraction. Startups should demonstrate early signs of traction, such as user engagement, customer feedback, or partnerships. The barriers to entry. Investors should be interested in understanding the startup's competitive landscape and the barriers to entry in the market. And last but not least, the valuation. Startups should consider their valuation in the amount of funding they are looking to raise, ensuring that it aligns with their growth plans for the company. Here are some metrics to know before a seed funding round. Product validation. You want to provide evidence of your market validation, such as a working prototype, early adopters, or pre-orders, to demonstrate that the product has market fit and is solving a real problem. Next, you want to have user acquisition. So demonstrate that the startup's user acquisition plan is already in motion through early customer acquisition, organic growth, or partnerships with other companies. You want to have your market size identified. So you want to show that the market for the product is large enough to support a successful business. The revenue potential. While financials may not be as important in the pre-seed round, they are in the later stages. And so investors will still want to see realistic projections that demonstrate the potential for growth and profitability for your business. Team building. You want to emphasize the strength of your team behind the idea, including a combination of technical expertise, industry knowledge, and business acumen, preferably with a track record of successful ventures. And last but not least, retention. You want to evaluate the number of active users or customers and their engagement with your product or your service. Good retention rates indicate a strong value proposition and user satisfaction. Okay, so I didn't share common challenges faced during a pre-seed round because, again, that's really looked at as a friends and family round, and you may still be in an idea stage of your business. But there are some common challenges faced for founders who go up and pitch for seed funding round. Seed round is the first official round of funding. And here are some common challenges that founders face when they don't secure funding during this round. Not having a clear understanding of your business model. Startups should have a solid understanding of your business model, including how you plan to make money, the different income streams that you'll have for the business, the different cost factors that you have to consider for your business, because investors will want to know how you plan on generating revenue. And so you want to make sure you understand the different income streams that your company has potential for. Funding. Securing enough capital to support the initial market research and early product development can be a challenge. At the seed round, funding is typically given in exchange for equity or a signed agreement to provide convertible equity or debt at a later date. Managing investor relationships. And so building and maintaining relationships with investors can be challenging, as startups need to keep their investors informed and engaged while also managing their business expectations. Dealing with other financial pressures. So after accepting seed funding, startups may face increased financial pressure to deliver results, to deliver more funding, and to achieve the milestones that was agreed upon, which can be stressful for the founders and the team. Scaling business operations. Startups need to be careful about how they scale their operations after accepting seed funding, as becoming too reliant on outside capital can lead to problems such as losing focus on the core product or the service that you started out with trying to solve. People. Hiring the right team members at the seed stage can be very challenging. Startups need passionate generalists who can set foundations for growth rather than experienced specialists who may be better suited for the later stages of business development. Last but not least, the process. So establishing a repeatable process for product development, for marketing, and for sales is crucial for startups at the seed stage. This can be a challenge as the business grows and evolves. And now let's talk about the metrics that you will want to know before a Series A funding round. So before a Series A funding round, startups should focus on several key metrics to demonstrate their potential for growth and success in the market. These metrics can vary depending on the industry and the specific startup, but here are some common ones to consider. You want product and market fit. So at this stage, startups should be able to demonstrate that there is a demand for their product or service in the market and that they have a unique value proposition that sets them apart from their competitors. User retention and engagement. Showing evidence of user growth, customer acquisition, and revenue generation can demonstrate that users are actively using and returning to the product or service. That can help investors see that the startup is gaining momentum and has a potential for scalability. Team execution. A strong and competent team is crucial for the success of a startup. Investors will look for a team with relevant experience, a track record of success, and a team that has the ability to execute the business plan effectively. You want market potential. So startups should be able to articulate the size of their target market and the potential for growth. This can include more market research, you understanding your industry trends, and a competitive analysis of the market. Last but not least, profitability and financial health. Showing a clear path to profitability and a solid financial foundation will need to be communicated and outlined in order to be attractive to investors. So founders should have a clear understanding of your company's value and be prepared to negotiate a fair valuation with investors. Here are some common challenges faced during a Series A funding round. So the Series A funding is the first institutional round of funding. And so focusing on the wrong metrics can be hurtful. So startups often focus on the merits of their product or the service rather than its potential market, which can lead to a difficulty in raising money from investors. So startups must define their target market and develop a clear go-to-market strategy and convey that to the investors. You may have wrong investor selection. So choosing the right investors is crucial for a successful funding round. Startups should look for investors who have experience in their industry and can provide more than just capital. One of the biggest mistakes startups make is approaching investors without thorough research and preparation, which can lead to rejection from a desired investor. Unrealistic valuation. So startups may overestimate the value of their company, which can lead to difficulties in securing funding. It's important to be realistic about the financial situation of the startup and its potential for success. Overestimation of the value can turn off potential investors, and so it's crucial to conduct a thorough valuation analysis, taking into account market trends, comparable company valuations, and revenue projections. The competition for funding. As startups grow and move from one funding round to another, they're facing increasing competition with other companies seeking the same investors and funding sources. So after receiving funding, startups need to demonstrate that they can deliver on the promises and achieve the milestones set out in their funding rounds so that they could continue to make a favorable impression on the next round of investors. Weak financials or low cash reserves. Most investors are looking for startups that have a healthy balance sheet and can demonstrate positive cash flow. Unfortunately, many startups lack the financial resources they need to demonstrate this potential. Team execution. A startup's team is the most valuable asset, and investors look for a strong and capable team to execute the business plan. Companies typically pursue a Series A funding round when they have outgrown their initial funding sources and have achieved certain milestones, such as proven market viability, gaining early traction, or building a solid team that's able to execute the plan. Last but not least, not being prepared for due diligence. Due diligence is the process by which investors evaluate a startup before making an investment. And startups should be prepared for this time-consuming and detail-oriented process, including checks into your financial processes, your legal processes, the operational and compliance verification. All of those things need to happen before you receive the check from the investor. And so having your paperwork in order, having your proceeds documented, those go to being prepared to receive capital for your business. In conclusion, understanding the various funding rounds that businesses go through from pre-seed to Series A through D is crucial for both entrepreneurs and investors. Each stage comes with this unique set of challenges and opportunities. Pre-seed funding helps kickstart an idea, while seed funding drives early growth, and then series funding is all about scaling through each challenge on the journey to your exit plan. As businesses progress to Series A, B, C, and D, they face increasingly scrutiny and expectations for growth and profitability. Challenges can range from attracting the right investors to maintaining a sustainable growth rate. However, with a clear strategy, a compelling business model, and a resilient team, businesses can navigate these challenges successfully. So whether you're a startup founder seeking funding or an investor looking for opportunities to invest in, a deep understanding of these funding rounds is essential to making informed decisions in this dynamic world of entrepreneurship. I hope you enjoyed this episode of Business Pitfalls and Profits. If you like this video, don't forget to hit that like button and subscribe to the channel so that you don't miss our next one. And most importantly, share it with your fellow entrepreneur advocates. Until next time, stay curious and keep thriving.